Have you ever been in a bullish trade where it seems like the market was just waiting for you to put the trade on so that they could push the price down and shake you out of the trade, only to rebound later, confirming your premise, but you're sitting on the sidelines with a loss? Sound familiar? I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are faced with this situation all the time. The difference is that they're trained in techniques that can overcome these frustrating situations and turn them into wins. So if you're interested in a technique where you can avoid being shaken out of a trade, where your original trade thesis actually turned out to be correct, then stick around because I think you're going to find this eye-opening. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. It goes without saying that all the major indexes have been in a downtrend all year as inflation has reared its ugly head, forcing central banks all over the world to react by tightening up monetary policy, which is not good for the stock market, as most people know. But just like no bull market goes straight up, similarly, no bear market goes straight down, and there will always be bearish days in bull markets and bullish periods within bear markets. That's just the way it is. But it's tricky business figuring out when to get long in the midst of a downtrend, and no matter how skilled you are, you're going to be wrong sometimes, in which case you'll be either having to take a loss because the market keeps selling off, or you can use an options technique for turning an apparent losing trade into a potential winner. This is a simple options trading technique that can be a game changer for you. Now, before we dig into the details of how that strategy works, I wanted to mention that if you're interested in learning 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. In order to teach you this option strategy that can turn trades that are going against you into eventual winners, we have to make sure that you understand how put options on indexes work, because those are the kind of options we'll be using in this example. If you already know how they work, then just hang in there. This is going to be really quick. And so the best way to understand a put option on an index is to think of it as a bet. The put buyer pays the put seller what's known as a premium to place that bet. The bet pays off if an index closes below what's known as the strike price of the put option on the day it expires. If the index does close below that price on expiration day, then the put buyer gets $100 per point that the market closes below that put strike price. So, for example, if an index closes at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put's strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. In that case, the put seller just gets to pocket the premium he received for selling that as his profit. And that's really all you need to understand in order to follow the example we're about to teach you. Okay, so with that said, let's head back to earlier this year in February when the index of small cap stocks, the Russell 2000 index with a ticker symbol of RUT, was trading a little bit above 2,000, having dropped to as low as 1901 in late January. And so let's say that on that day, for whatever reason, you felt this sell-off was overdone and we are ready to get bullish. Well, as an options trader, you have a lot of tools to get bullish, and one of the simplest ones is what is known as a put credit spread. And so if you pulled up an options chain of the RUT index expiring in a month in mid-March and you went ahead and sold 10 of the 1960 puts expiring on March 18th, which are located 100 points below where the market's trading, and at the same time you bought 10 of the 1950 puts for protection, well, when you do that, you've entered what options traders refer to as a put credit spread, as we mentioned. Now, from a cash flow standpoint, it's important to understand that when you sell those 1960s you received, in this case, a price of $36.20 for those options, and remember, each option represents a payment of $100 per point if the index were to close below that strike price of 1960. So you multiply that by $100, and you sold 10 of them, resulting in a total cash inflow of $36,200. Then you turn around and buy 10 of the 1950s for $34.35, and those are for protection, resulting in cash outflow from buying those in the amount of $34,350. And so the transaction actually creates positive cash flow for your account of $1850 when you net the two together. And your broker, incidentally, will require you to have at least $8,150 in your account to make this trade, which is the most you could possibly lose on the trade. And so if you think about this trade, essentially what you want to happen is for the index to either rally or at the very least, if it's going down, to close at least above 1960. And that's because, as we explained before, if a put is located below the final price of the index the day that it expires, the put expires worthless, and so would the 10 at 1950 below that, obviously, and you'd get to just pocket the 1850 that you collected at the beginning. However, what would you do if the market keeps selling off after you put the trade on, and now the price of the RUT actually reaches your short strike at 1160, which at the time you put the trade on was a full 100 points below where the market was trading? Well, that's exactly what happened on February 23rd when the RUT index dropped below the 1960 short puts location. And so when that happens, options traders are trained to what we call roll the trade down and out of trouble. And the way that that's accomplished is by first buying back the short options at 1960, simultaneously selling the long options at 1950, and then reestablishing the position with a little bit larger size. So now we will be selling 15 of the 1840 puts and buying 15 of the 1830 puts, as you can see from the options chain. Now, let's analyze what this has meant from a cash flow standpoint. And as you can see from the calculation, we start with what we received when we initiated the trade 6 days earlier, and subtracting the cost of buying back the 10 1960s and the cash we received from selling off the 10 1950s, and then further adding the cash we received selling the 15 1840s and subtracting out the cost of buying the 1830s. When you net it all down, your cash flow is still positive, a little bit less positive than before, because we're left with 1265 versus the original 1850, but still a reasonable amount of cash. And now we're sitting more than 100 points below where the index is trading, with a little less than 50% more risk than we had before. Now, if we move ahead to the day these options expire on March 18th, you can see that the index had at one point actually sold off further to 1894, but it never reached 1840, where our new 15 lot short puts were. And then after that, the index bounced and was now trading over 2,000. And so if we do a final calculation on the trade, it's really pretty simple, in that all we do is acknowledge that after the roll, we still had that 1265 of cash remaining, and obviously both the short and long options at 1840 and 1830 respectively expired worthless. And so the final profit on the trade is simply that remaining cash after the roll of 1265. And so the real point I'd like you to focus on coming out of today's video is that if we're wrong on an options trade and the market moves against our trade, we do have the option of rolling the trade. What options traders refer to as an adjustment to the trade, where we can move the position out of harm's way until the bearish storm is over and the bounce we were anticipating comes. And while we may have to take some additional risk to make this happen, in most cases the market will settle down and at a minimum cease going down any further, or as in this case, bounce, which was our thesis from the beginning. Professional traders know techniques like this to buy time to ride the storm out, and then when the sky's clear, he can usually emerge with a profit if he handles the trade properly. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.
Theoretically, is your risk greater if it doesn't flatline and do that bounce?
Yes,
Roll over?
absolutely. And, these videos were going for 300 hours if I got into all those nuances.
Yeah.
Now you have more risk because now you got 15
But if you
lots.
lose on both, yeah.
Well,
But
if
you're
you lose
rolling
on
over.
both, you could theoretically roll it down and double down again. But there comes a point where
There's
you
more
just
dealing
got
with
to,
it, yeah.
you're first of all, you could be chasing a total dog stock all the way down to nothing, right?
Yeah.
So it's a dangerous thing to do. This is the kind of thing I would say you do once, maybe twice, if you catch it early enough. You see does anybody in the room know the concept of options deltas?
Yeah.
Okay, deltas are the rate of change of the options price based upon the rate of change of the underlying stock that the options are derived from, right? So, and the problem is as you get closer to the time those options expire, that change happens much more quickly. That's called gamma, the rate of change of delta. So some guys are like super hair trigger on adjustments like this. They'll say, as soon as the stock moves from, let's say you entered, I didn't check the deltas on this one. Let's say this one, the deltas are probably pretty high. This is probably like starting point of maybe 35 deltas or something. So if somebody starts at 35 deltas, they'll say, if the delta moves 10 points to 45, meaning the rate of change of the increase in the options price is now higher, then they'll immediately roll it back. Other people will wait much longer. The longer you wait, the more lots you're going to have to enter into to be able to compensate for how much you're going to lose, because the longer you wait, the more you're going to lose by closing the short option. If you catch it early, you may not even have to increase your risk at all. You might be able to, for example, reduce your risk to, you wouldn't be able to reduce it, but you might be able to keep it the same, but just make less on the trade. In this case, we needed to both move it and bump lots in order to do that. It's a very common technique. If you set aside enough capital so that if I need to roll, I will have enough capital to do that, right? And then the other thing that's key is you can't get into rationalizing. Sometimes a stock is just a dog, and it ain't going to go up. No matter how much you want it to, it's not going to go up, right? So you have to put a stop on the whole thing because it can just get worse and worse and worse, right? So typically what I tell people is use the same stop you used when you had the first number of lots. Then it never gets worse than the original 10 lot stop would have been. And typically people do, very commonly they'll do a multiple of the credit they get in. So in this case we got a credit of $18.50, right? We received cash of $18.50. So most people will say on a trade like this, you would never want to get past 2 times that credit. Because think about it, if you do 100 of these and you allow the losses to be 2 times the credit, then you've got to win on 66% of the trades to break even. You got to win 2 for every 1 simply to break even, and that ignores commissions, right? And slippage and all the other stuff, which is a reality, right? So yeah, so most people will go with more like 1.25% to 1.5%. Yeah, no, I'm sorry, 125 to 150% of the credit is the amount that they'll use as the maximum loss on a trade. So then it's more like whatever the math is on that. You don't need as good of a win rate in order to succeed with that. Of course, you're going to get stopped out of more trades because you're going to be, closing it more quickly.
I'd say I was just a little confused. So are you just rolling a credit spread down to the? Is that what you said? Like, are you?
Yeah, you're rolling it down. What we did? Yeah, this is the key.
Like you're placing another credit spread.
Yeah, you're
below
closing,
that
you
one?
see how that closes the first one? You plus 10 closes the minus 10, minus 10 closes the plus 10 on the original spread. Do you see that?
Yeah, yeah. I do.
Okay. So
So
you could see that as
you're
two
still-
separate
You're
transactions.
still setting a max loss. This isn't going like if you really mess up on this. This isn't like you're blowing up. This is like it's a bad loss, but you're still
No,
limited. by
right,
the
yeah, there's
credit
gonna be
spread.
stop, every loss, that 8150 you can lose, if you lose that, you're fired. In other words, you're not, you can't lose the entire spread. That's losing the entire spread. That means the rut goes down to 1600, and both of those options are maxed out. So,
Yeah, but that's your.
but
max
what's
loss.
gonna happen is, as the market's coming down, that spread's gonna widen,
Yeah.
and that widening is what's causing your loss. Because the debit you'd have to, the reason why the widening causing the loss is because the debit you'd have to pay is larger. Because basically what's happening is the short option is growing faster than the long option because it's farther from the money.
Yeah. Okay.
You see? So,
Yeah, I just wanted to know how this was different than that. When we went over credit spreads the last time,
yeah.
you were able to limit your max. Like you were able to limit it to a max loss value.
Yes. You always can. Yeah.
Yeah. So in this case, we're doing that, but it's much larger if it really goes bad.
Well, there's a difference between the worst you could mathematically lose and how much of a stop you will allow yourself. Those are two very different things.
Yeah.
If you let a credit spread go to its maximum loss, you are never going to make money trading options. You've got to close those spreads far, far before they go to a max loss.
Oh, and you can.
Yeah, you just go into the market and all you do is, and this is just a little trick you remember, when you set up a credit spread trade, keep that on your platform. It depends on which platform you're using, but most good options platforms allow you to set up what's called a complex order. So a credit spread is a two-legged order, so that's called a complex order. A simple order is a one-legged order where you're just buying or selling an option, right? But if you're doing a combination, that's called a complex order, and there's an electronic thing called the complex order book where market makers can go in and decide if they want to fill any of those or not, right? It's all done by computers, but okay. So on this trade, for example, let's see, what did we get? When we got into it, we got 1850. So now, just, you do this long enough, it gets easy to just do it automatically. So this spread's now worth 365. 6870 minus 6505 is 365. You multiply that by 10, that's 3650. So you got in 1850, but to close it, you have to pay 3650. The reverse transaction, the debit to buy, the debit is just the reverse of the original credit transaction. You're selling the long, you're buying you're selling the short, you're buying the long. In the reverse, you're buying the original short, you're selling the original long. Okay, so you keep that transaction, then you flip it. Well, every trade I do, I keep that trade preserved in my platform. So when I want to reverse it, I just hit opposite order, whatever they call it on your platform, and then you do that same thing. So in this case, I would have had that credit spread set up. I would have flipped it to a debit, bought it back, and then rolled. In fact, you can do this depending on how good your platform is. You could do this entire transaction as one complex order. Some won't really let you do that. You'll have to do a 10 lot here and then add another 5 lot credit spread for a total of 15.
Put that on from the beginning as one order.
You could, if you have a good enough platform, it'll allow you to do a 10 lot on this side and a 15 lot on the other side. But those also, that's like an imbalanced iron condor. This is a put side condor. This is an imbalanced condor, and some platforms won't let you do it. Other ones will, but even if they will, it's going to be hard to fill. See, market makers have computers making all these decisions, right? Yeah. So if they see something normal, they'll fill it. If it's abnormal, some market makers are like, that's too weird, I'm not dealing with that. And they'll only deal with normal looking trades, right?
You just place them separately, same thing. Ends up being the same thing.
It's much better to, anytime, this is another thing to remember if you're going to get into complex options orders, anytime you have a multi-legged thing, you want to put it all on at once. And let me tell you why. Forget about the fact that we had something on. This is a transaction, right? This is a new transaction. This is a new trade, right? So this one fills, this one, you put in a price. If the market goes up, your price will get filled because this is a bearish position. Closing this is bearish. So if you put a price in and the market goes down, the market's going to demand a greater price in order for you to fill this. But if the market goes up, it's going to take the price you gave it because now basically you're overpaying for it. The market maker will only fill your order if they think you're overpaying for it. That's the reality, right? Yeah. Okay. This one, on the other hand, your price will fill when the market's going down because this is a bullish position. And so since it's bullish, since you're trying to sell it, if you sell it at one price and the market thinks, no, actually, this is worth more, the market will fill it. The market thinks you're giving it a bargain. Okay, so I know this, you got to think backwards on all this stuff. It takes a little time to get your brain going on this stuff. But anyway, so when the market's going down, this one will fill. When the market's going up, this one will fill. So here's what happens. You're trying to break it down into two different spreads, right? So the market rallies, this one fills, you can't get this one filled. So you have to chase it. So you keep chasing it until you get a shit price for it, right? So what you've done is you got one side filled and you're chasing the other side. Yeah. Whereas if you put the whole thing on as a single order, that has a single proper price in the market.
It won't fill.
And it will, and so therefore yeah, you might have to chase it a little bit, but you have a much better chance of not getting screwed if you take it as a total. Basically, breaking it up almost guarantees you're going to be screwed, because one side will fill, while the other side you're going to have to chase.
Does Silex let you do that?
Right. What?
Does Silex let you do that, or?
Absolutely. Yeah, Silex. Now, this is weird because this is imbalanced. If this was normal and it was just all 10 lots, then that's a very easy thing to fill in Silex. You can still go in and change the lot size on the put on the bottom puts in Silex. You can do that, but you got to go do it. Whereas it'll automatically set this up at the same number of lots if you do what they call locking. I think they use the term lock size or lock lots or something. There's some setting where it locks it, meaning if you change this to 5, it'll change all of them to 5. So anyway, yeah, remember, anytime you're doing a multi-legged spread, try to do it all at once if you can. That is your insurance against not getting screwed on price. Mm-hmm. Anytime you break it up, you're almost guaranteeing yourself you're going to get a worse price than putting it together. Unless you're great at price action. And you actually can't. Some people are really good at legging in, and they'll say, all right, I'll let this one fill, and then I believe the market's going to come back down, and then this one will fill, and you may end up with a better price by breaking it up. A guy like Steve or any of the better traders around here probably are better off legging into trades like this. But you got to be, I don't recommend it in the beginning because you got enough to worry about.
Yeah.
So you might as well know, okay, the execution on this trade, I'm not going to have to worry about. I'm going to get a fair price for it.